All right, guys, welcome back to We Talk Money in person. Live
Hey!
in person.
What up? Look, I can touch him. I can high five you.
It's good to be back, man. We've been on the road, traveling, been in the woods, been in Asia. Now we're back in Austin. How you guys doing?
Doing great. It's great day to be in Austin.
Yep.
Yeah.
We didn't prepare too much for the show because I know there's just so much happening, and the Fed rate announcement just came out. They raised another 25 basis points. Let's just dive into it, guys. Is the Fed breaking the markets? Are they making massive mistakes, or is this a smart move? And is the whole banking system about to implode? What the hell is going on this week?
A smart move.
I already tweeted out that I thought this was maybe as dumb as the Fed being behind the curve at the beginning of this whole rate cycle.
Yeah.
When they were still doing QE while we were watching inflation numbers go boop, 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 boop. And we were like, what are they doing?
So we're not surprised, so to speak.
Yeah, exactly. So now I think they're on the other end of it, and they're making a mistake doing the opposite. Now they're getting too aggressive. I mean, Fed funds is above current CPI, and the CPI by like late summer, early fall is going to be well below Fed funds.
Yeah.
Oh, and by the way, you've got 2 of the top 20 largest bank failures happened what, in the last 2 months, 3 months?
Yeah, check this out, guys. Looking at this chart that was going around FinTwit, U.S. bank failures have now exceeded the 2008 financial crisis, just with a few banks, right? Like Signature, Silicon Valley, and First Republic. That is basically dwarfing what we saw initially in 2008. So is this the start of contagion? Is shit about to get really, really bad?
Yeah, I mean, yesterday, the KRE Regional Banking Index, or the ETF, was down 7%. We had PacWest Bank Corp, Western Alliance, those were all down at more than 20% yesterday. And the market is going to keep shooting bullets. I mean, you know, it's until it's fully resolved, which I don't think it gets fully resolved until the Fed starts cutting rates, because cutting rates does 2 things. It helps the asset side of the balance sheet. We know that banks have had problems with their bond portfolios being marked down, and potentially some of their CRE loans and things like that. Cutting rates helps the value of the assets. It also helps the liability side, where they're losing deposits to money market funds that are paying higher interest rates. Mm-hmm. So if you lower rates, you fix both sides of the problem. It doesn't mean we won't maybe have any more bank failures, but it certainly would help a lot.
Yeah.
And so raising rates is doing the opposite.
Well, it looks like if we take a look at the CME Fed Watch, the probabilities for the future, as of right now, it looks like the market is pricing in, I guess, no change for the next couple of months. And then by, Q3 and 4 coming back down to reality, back into the 3% range. Mm-hmm. You guys think that's going to play out this way, or are they going to cut more aggressively or do something even more stupid?
Well, I have my opinions, but I've already been expressing them in a very exasperated way. So I'll leave the floor to you.
I think that I was kind of talking about this on the stock market update. I think that Jay Powell is going to bang his chest, or, the board, they're going to bang their chest. We're fighting inflation. They're going to hike this time, which they did, and then they're going to pause. Mm-hmm. So I feel like this was an obligatory hike for them almost. Like if I'm thinking about getting behind the brain of what is going on at the Federal Reserve, that's kind of where it leads me, because it doesn't make sense otherwise. It feels very risky otherwise. And so I feel like that's what they did. They're like, we have runway right now to be able to hike since the labor market's holding up, mm-hmm. even though there's banks failing, and even though, consumers have every incentive to go pull their money out of a bank and put it into a money market mutual fund. But they're just going to have to do what they have to do so that they can have that room to reduce rates. For a decade, they were 0%, right? So maybe they're seeing this as like, oh, well, this is our chance to fix a decade of terrible, I don't want to say terrible zero interest rate policy, but, a little bit, it ran its course, right? And now they're trying to like go off of that and backtrack from that a little bit. So I think that this was something they had to do in their mind. Was it smart? No. I think that they know now if they keep hiking, they're going to just lose credibility completely. If they already haven't lost credibility, they will.
Yeah.
And so
So how does this shake out? Again, I'm going to put on my like Bitcoiner hat and the hard money guy hat and say like, yeah, the Fed is reckless. This is a terrible idea to have a small group of people that control the money supply and interest rates this way. And I don't know. It feels good to have Bitcoin, obviously, but it's also kind of a scary time because if the banking system like collapses or like things get even worse from here, that's not going to be good for anybody. So let's war game this. What's the bull case? What's the bear case? Like, what are the potential paths we could go down, and how could traders and investors position ourselves to not get hurt or to maybe even profit from this?
Yeah, it's a great question. I think I think a base case scenario would be that, you sort of thread the needle and like you have a perfect Goldilocks soft landing. At least that's what the Fed's base case is. That's not my base case. My base case is that they've already done too much and they've pushed things too far, and we're going to see the result of that. And basically they've hiked until they break stuff, and we've already seen things break. We'll see more things break.
So let's go down that rabbit hole. Like, what does that mean? More things break. What do you think is going to happen?
Well, this is why the bond market is saying through the yield curve that it expects rates to get cut by later this year. And in fact, I think the bond market is still saying that rates will be cut in November and December, and then again throughout early 2024.
Yeah.
And a lot of people in the higher for longer camp, a lot of really smart macro people on FinTwit are saying, no, inflation is sticky. The Fed needs to stay higher for longer. The economy's still strong. Unemployment rates are still low. They can't really fight off inflation yet. And they certainly shouldn't be cutting rates. I understand that view because unemployment has been pretty low and sticky, and the economy is doing still surprisingly okay. But what the bond market is saying, I think, is actually correct, not the higher for longer camp, because the bond market is saying that, listen, if you look at CPI and where inflation numbers are going to print in 3 to 6 months, it's going to look very different than what it does today. It's basically the difference between looking at the data today and looking at the data in 6 months. And the bond market's looking at the data in 6 months. And I did a thread on this on Twitter and said that, listen, we might actually have a CPI head fake in April, because CPI, according to the Cleveland Fed forecast, is going to be at 5.1 or 5.2, which is actually at a rate above where it was in March. It'll be the first time in like 7 or 8 months that the CPI actually ticks up again. But it's going to be a head fake. And it's going to be a head fake because I think around June, July timeframe, the Dallas Fed has projections that the largest component of the CPI, the owner's equivalent rent, basically the measure that's supposed to capture rent prices and home prices, that number is going to start putting downward pressure on the CPI. So by like the fall timeframe, CPI is probably going to be at like 3 or 4%, maybe even below. And so the Fed's going to look very offsides. The Fed would then have cover to cut rates. And especially if we get more banking issues, more economic weakening, then it makes sense to me what the bond market is saying, that the Fed's going to need to be cutting in 6 months or maybe even sooner. So that's kind of my base case view. So basically what it looks like could happen too, if it's not a Goldilocks event, then we could get pushed into Fed rate cuts quickly by economic weakness, recession, or bank failures.
Okay. So the markets seem to, I don't know, do they just not care right now? If we look at the charts, Bitcoin is still holding up close to that 30K resistance level, which is multi-year resistance. Like if you look at a yearly chart, this was 30K is the close of 2020, the open of 2021, and like the mid-range of 2022. And so also, if you look at, like the NASDAQ, it's also at 2020 and 2021's kind of really important price level. So the markets haven't gotten crushed by this yet. They're just kind of hanging out, volume's kind of shrinking. Like what's happening? Why isn't the market either squeezing shorts or just taking a massive dump?
It's so interesting because there's all these cross currents, like especially for crypto, the analysis is a little bit different than, say, for stocks, even though they're both risk asset classes and they have been trading correlated at certain times over the past couple of years. Like we have this thing, the debt ceiling fight, that's like coming front and center. And crypto sort of plays a role as an alternative to that. What if we get a worst case scenario? So it's sort of, and that probably helps crypto.
Bank failures.
Yeah, bank failures. That probably helps crypto.
Yeah.
This idea that we might have a deflationary event or some event that pushes the Fed to cut rates would also argue for being long duration assets, things like stocks, Bitcoin, growth stocks like we saw in 2021. So that's why I think stocks are sort of like looking at what the bond market is looking at 6 months out and saying, well, if rates are going to come back down, something's going to happen, the Fed's going to blink. Why wouldn't you want to own long duration assets again? And then, oh, by the way, you also have this whole thing with earnings still holding up a little bit better than expected. So people are like not being spooked out of stocks, at least not in, some of the sectors outside of financials.
Yeah.
Unless Apple, craps the bed tomorrow.
That's right.
That could
come. Earnings are tomorrow after hours?
Yeah, after the close. And the Apple earnings could shift the whole sentiment of the stock market, in my opinion.
Yeah.
I know it's just one company, but it's a very important company because you got to understand a lot of people flocked to safety in Apple over the past year or so. Even though Apple is not a cheap stock, even though Apple, their growth has slowed down and, we're seeing possibly iPhones slow down and hardware, whatever. Yes, but people use Apple as a safe haven.
Mm-hmm.
So if Apple craps the bed tomorrow, that is what I think could turn everything upside down in terms of the stock market, in terms of the NASDAQ and the S&P 500.
Yeah, if we take a look at the, the Apple chart, Apple's actually got a lot of downside potential because as of right now, it's still holding off just maybe a few points off of all-time highs.
Which is crazy. Can we just take a moment to recognize that? That we're that close to all-time highs?
Yeah.
What?
It's wild. One thing that I've been thinking about too, like on the unemployment front, is there was big news this week that IBM was planning to replace 7,800 jobs with AI over time, and it has paused hiring certain positions. I think this is going to accelerate a lot faster than people think. I mean, what was the education company that was down like 50% this week?
Chegg.
Yeah. What they announced, they said ChatGPT is basically eating our lunch. What's the ticker? Chegg?
CHGG. Yeah, they said that they were starting to see an impact on new customer growth from ChatGPT and AI products.
Massive gap down this week. Let's see, it was down from 18, down basically 50%, just on the idea that it's even beginning to eat its lunch, right? So this, I think, is going to be maybe deflationary and also kind of dangerous for the employment situation too, right?
Absolutely.
And that, I guess, is the other side of the coin, right? Is the labor market's been strong. There are, even though job openings have come down, there's still a lot of job openings per se in relation to pre-pandemic.
Mm-hmm.
And it's like, there's, again, another tug of war within just the labor side alone. And because the market is kind of depending on a strong labor market right now so that we don't fall into a deep recession, quote unquote, soft landing, whatever.
Yep.
And the other side of that coin is here we have AI that really is potentially going to shrink the need for a lot of these knowledge jobs, or even data entry jobs, or I don't know, anything you could think of, we could probably come up with reasons why we may not need it anymore, except for plumbers and contractors and people doing physical labor, right?
Yep.
So that is kind of the tug of war within the tug of war that we're experiencing now. And it's just mind-numbing at this point.
It's wild. So 2 weeks ago, we talked about earnings season being in full swing. What has happened since then on the earnings front? And maybe we can look at some PE ratios and stuff, kind of diving into the data here.
Yeah, so the market expected that for Q1 2023, which is what companies are reporting right now, the results from Q1, that the market expected in aggregate, like the S&P 500 aggregate universe of companies would report an overall decline in earnings. I think the expectation was for a decline of about 6 to 7%.
Yeah.
Mm-hmm.
So far, I think with about 2/3 or maybe even 3/4 now of the S&P 500 reporting, the earnings decline for Q1 is only about 3% or 3.5%. So there has been a decline in earnings year over year.
But not as high as expected.
That's right. And everything in the stock market is about expectations and about the future.
Mm-hmm.
And so that's helped, again, the market to stay, relatively positive and basically, not go down further because the market's saying, hey, actually corporate earnings are not falling off a cliff like we thought. And now you could actually maybe look forward into the second half of 2023 and say maybe earnings start growing again.
Mm-hmm.
And perhaps the market doesn't look as expensive. Now, again, I think a lot of that probably depends on your view of what happens in the macroeconomy. Because by Q3, Q4, if the Fed's done too much and we're in recession or we have more bank failures, it's going to be really hard for corporate earnings to keep growing. Or to grow again, rather, because they are shrinking right now. But yeah, as it stands today, not as bad as feared. So it gives the market potential for a run higher, maybe even to new highs.
And then, if the market's looking forward, as we know it does, to rate cuts, and then rate cuts lead to more business investment, which we know from the GDP numbers, that it wasn't the consumer that was the problem. It was the businesses. It was the fact that they're not doing the spending that, consumers are buying and doing and whatever, services mostly. But the business investment is an issue. So it's like, okay, the stock market could just be looking forward to that and saying it's like a domino effect. The Fed reduces rates because of whatever, bank failures, all these things. Then companies start to be able to have lower rates to do investing. And then boom, we see growth again and the cycle starts over. So I'm wondering how much of that is the stock market looking at. People that are looking for these new lows in the S&P 500, I'm just not seeing it yet. Like, I don't really know what it's probably going to take a couple more bank failures for that to happen.
The picture could turn very quickly, right?
It could. And who knows what Apple is going to put out. And the market has been very reactive. Yep. So it's kind of one of those situations where you almost can't get too comfortable. The market's been holding up super well, but you can't get too comfortable because we know it's like a big baby. It throws a tantrum at like the last minute,
That's a good
That's how it's been acting over the past, I would say, year-ish. It's been throwing tantrums at the last moment.
Yeah. Mm-hmm. So let's take a look at some other markets real quick. So one thing that we've been saying for the past couple of years actually is one of the strongest charts out there is gold. It's also hovering around all-time highs. It's got a massive cup and handle pattern. Kind of inverse to that, I don't know if it's really inverse, but the other side of the market is oil and energy has just been really dumping. So that's also going to help inflation numbers. What's the reason? Because I know a few weeks ago or last month, OPEC said they were cutting production, right? Mm-hmm. So prices had a gap up. And then what's causing the sell off this month?
It seems like there was some data that came in that the Chinese recovery was a little bit weaker than people had expected. So the demand side, there's some questions there. There's still questions about the supply side. Like there's a lot of shadow supply that the data doesn't track super well. And frankly, it just looks like, it's still relatively weak demand versus supply. So unless OPEC, really sticks to the cuts and makes deeper cuts, the energy markets are saying that, all is fine on the supply side and demand's actually not that strong, which is interesting because if you look at things like travel data, the airline data shows that people are traveling more in aggregate than they did even pre-pandemic in 2019. So the services and travel numbers are super strong.
Didn't Hilton have a banging quarter?
Yeah.
I think Hilton and a few other chains, I think reported pretty great quarters on the hotel front, the travel front.
So people are still traveling. They're still spending money.
Isn't the stock booking? Isn't that rallying right now?
Yeah, booking's been strong. Yeah, a lot of the travel stocks have held in pretty well. So I think it's a little bit confusing. I'm not as close to the oil market as I am to say stocks. So I'm sure there's some other minor things happening. But yeah, it's kind of surprising, frankly, because you would think with the economy still holding in that energy would still be more stable. But right now, at least it's headed the other way. One little bright spot has been uranium, which is interesting. We took a trade there this past week that we alerted to the community. There's definitely some interesting things happening in that little sub-market. But
nice. I saw your tweet thread here about what the bond market knows that investors don't. Do you want to give maybe a little recap of this?
Yeah. I think I covered a lot of it earlier here in the episode, but basically, a lot of people are confused that the bond market in particular is pricing in the Fed cutting by the end of the year, even though the Fed keeps saying, no, we're not going to be cutting this year. We're not going to be cutting this year. And the bond markets, you'll be cutting this year. We're all going to be banking at JP Morgan by the end of the year.
Yeah. Really?
We're all going to be employees of BOA.
That's a scary thought.
But yeah, I called out this fact that, most people are overlooking the owner's equivalent rent measure of the CPI. Again, it's 25% of the overall CPI. And there's actually another rent measure included that if you add those together, make up about a third of the overall CPI. In fact, 34 or 35%. They are the most important components of CPI, but what a lot of people don't really focus on is the fact that they're super, super lagging measures. And so what the numbers reflect, say, in April or May, are going to be what home prices were doing 12 to 18 months ago. But as we get closer, as we get further down the line, as we get through summer and early fall, those numbers are going to start to reflect 2022 and 2023 when we started to have home prices cool off and actually come down. Mm-hmm. So starting around the June, July timeframe, the OER component of the CPI is going to be putting downward pressure on CPI. So again, unless oil spikes to like $200 a barrel or something crazy happens in some of the other components of CPI, the CPI is destined to come down to well below where the Fed funds rate is today. And that, again, I think is mainly why the bond market, that and probably some expectations of a weaker economy, are why the bond market's saying the Fed's going to need to cut.
Enjoy your positive real rates while they last.
Mm-hmm. Yeah. So I guess my next question is, are you guys still in the mindset of T-bills and chill, or, what's the play right now? Are you being tactical with any stocks or, uranium type plays? Like, where's your focus?
Yeah, I've I think we talked about this 2 weeks ago, but, I was trying to see the case for being more bullish. And we talked about it just now. The one case for being more bullish on risk assets is if the bond market's right and rates start getting cut, maybe we have a market decline before that. But at that point, rates start to get cut, maybe the market can actually start to, take growth stocks and risk assets higher again. So that would be one reason to get more bullish. So I've been trying to look at ways where I can get into maybe some incremental trades, not too much size yet, but maybe start to think about where I'm going to place some bets. And then also, of course, still in the T-bills and chill mode of keeping a lot of excess cash, a lot of, because this is going to be turbulent. We still got the debt ceiling. We still got, if the Fed does have to flip-flop from hiking to cutting, it's going to be some weird market moves between now and then. So T-bills, unfortunately, the yields have come down in recent weeks with the banking failures. So, I think even like the 2-year bond is now sub 4%. So you can't quite get as much yield, but you can still get a little bit of yield, at least until the Fed starts cutting again.
Makes sense.
Yeah.
Nikki, what about you?
So I'm still in kind of patience mode. I do want to add some growthy, techie names to my portfolio. And I also want to add some consumer discretionary stuff as well, which sounds a little nutty. Mm-hmm. But this is what I do. I try to play those market cycles. Right now, we're in a downtrend with the consumer spending, or on goods specifically. But there are certain names, like Target is one on my list that I would love to put more in the portfolio. But just trying to stay patient through this earnings season. And then I think that if we do see any dip from here in the broad index, I'm probably a buyer. I think that if I see something deep enough, that's I probably from here, even if it's a higher low, am going to be going in.
Awesome.
So just staying patient with my cash, watching how the rest of earnings season shakes up, watching how inflation goes, because as you guys know, I've kind of made the case for disinflation equals higher disposable income. So that's the other side of the coin too, that could hold the market up. And we have seen disposable income improve. Mm-hmm. So everything's kind of going in that direction to where I'm dip buying probably going forward.
Cool.
But staying patient.
What about you, Chris? What are you seeing on the crypto side? Where's your head at?
Yeah, man. Good question. So I'm long, obviously. I bought the 19 to 20K dip here in March and took a little profit, bought back in on a breakout. And now I'm paying really close attention because, this 30K zone is a major level, right? As we talked about earlier, it's a very major price level that I think could hold for a while. I would actually prefer to see like maybe a few weeks or a couple of months of consolidation above like 25K to 30K and then get a breakout above that. But we still have to acknowledge the fact that Bitcoin is still very closely correlated with stocks. So if the NASDAQ takes a big dump, I think Bitcoin's going to go down initially with it. The caveat there is like there is seemingly like this flight to Bitcoin and gold right now. Mm-hmm. A lot of people are going, okay, this banking crisis stuff is pretty scary. Maybe it makes sense to have a portion of our wealth in Bitcoin, right? So because of that, I'm also in the same camp as you, Nick. Like any kind of dip, I'm a buyer until that thesis is broken. Mm-hmm. So I'm long. I'm paying close attention to this area. If it breaks support, I'll probably take some more profit. I've started to become a little more interested in alts, even though it's still a very risky situation for alts right now. If we look at the Bitcoin dominance chart, you can see that Bitcoin dominance is hanging out around 48%, which means that Bitcoin makes up about 48% of the total crypto market cap. And whenever you get a big altcoin season, that goes lower. It's dipped as low as like 40%. I've been in the camp this year so far that we're not going to get an alt season because of the overreach of the SEC and basically the slap down that the Biden administration's put on crypto. But the good news is there are people in the space fighting back, and like Gensler's getting put on trial, basically, metaphorically, like, what are you doing? And like Coinbase is opening new offerings outside of the US now, and people are going, hey, you guys are driving innovation outside of the US. So we're seeing that tug of war also play out. But for me, I've just been really tactical and really slow in trying to trade alts right now. I'm looking for anything that has relative strength over Bitcoin and beautiful price patterns. That's about it. I'm not shotgunning this. I think there's still a lot of shit out there that's just way overvalued, and I'm being very, very conservative with that. So I took a breakout trade this week. As of right now, it's just flat or pulling back. So we're just not in that market environment where there's a ton of momentum. Like we know when we're in alt season, it's like shooting fish in a barrel. It's like you're doubling your money every couple of weeks on these trades.
Yeah.
Right now, it's just we're not in that environment. The capital flow is just not happening. Yeah. And so I'm just playing it a little safe.
Are you, would you say you're kind of probing trades to see how the environment is looking, and maybe it's not up to what you thought in terms of momentum yet?
Yeah, I mean, but this is how it starts, right? This is how bull markets begin, is like Bitcoin kind of takes off and starts to show bull market action. And then you get some of the majors that get pops, ETH and Solana and stuff like that. And then the capital kind of trickles down to the smaller cap stuff. We just really haven't seen anything that's outperformed Bitcoin aside from like the odd, like, meme coin bullshit, right? Like there's been some of that's been popping off, and then, people chase that and then it crashes 90%. Like I don't really play in that space too much. Like the micro cap or the ultra shit coin stuff that I know is going to zero in 6 months. It's like, I don't have the risk tolerance for that anymore. So I've taken a couple of stabs over the past couple of months at breakouts, but that's really it. I'm not doing the shotgun approach.
I've seen you post some pretty good looking charts in the community lately, and I was like, oh, dang.
Yeah, I mean, I'll pull up a couple of charts here that are looking like they're strong. I mean, ETH, number one, had a breakout above 1,800, pulling back to support. There's a couple other like smaller cap ones. Some newer coins so Render, this is one that
That's
took
the
a
one
breakout.
I saw.
Yeah, I mean, like this had relative strength over Bitcoin. It moved to a kind of a smaller Fibonacci extension level here at 250. But, it's stuff like this that I'm looking for, where I see increasing volume. I see a nice price pattern. I have good risk to reward, things like that. Anything else that's just mediocre, I'm just kind of ignoring.
Curious what the crackdown on exchanges will do to alt season in the next alt season. If it's going to matter that the U.S. investors in particular have less on-ramps to crypto, or if that's really not going to be a problem. It'll be interesting to see.
I think it absolutely will have an effect, but I mean, capital's just going elsewhere, right? And people are going to solve this problem. Like decentralized exchanges, you can't stop humans wanting to participate in financial markets. And the SEC can try as they might, but like people, I think, are going to figure out a way to get around it.
What did you think of that Gensler testimony? What was it, a week or two ago?
Oh man. Yeah. Look, all I'll say, so in 2018, I went to a crypto conference in San Francisco, and Gensler was rubbing elbows with everybody, playing buddy. And I was like, man, I don't know. I just didn't trust him. So he was giving a speech, and I asked him about the accredited investor thing. I was like, what do you think of this? And you can tell. I mean, the guy's just a politician in the way that he thinks and talks, and like,
aren't they all?
Yeah, I don't know. It's ridiculous. I mean, what did you think?
I thought it was pretty pathetic that he couldn't answer a basic question at the hearing.
Right. Is ETH a security? Yeah.
Well, and then like even other questions that were asked of him to try to simplify it even further, it was like he couldn't even ask, or he couldn't answer just a very simple like yes/no question. even outside the is ETH a security, which maybe is a more complicated question. There were simpler questions asked of him, and he wouldn't answer them. And I was just like, dude, this is pathetic. Like, if this is what your life is as an SEC bureaucrat, like, oh, like what a horrible life. I mean, what a horrible way to be, you know?
Yeah, I mean, I try to get in his mind, right? And it's like, well, he missed some of the biggest obvious frauds and implosions, and now he's going after like Coinbase and Kraken and like people that are trying to do the right thing.
Yeah.
It's like, bro, this is a double miss.
Yeah.
Like, yeah, I don't know. I mean, I just think that it's a shame that US people are getting kind of pushed out right now. But you can't stop this. Yeah. I mean, you can't stop the innovation that's happening.
Yeah, well, and you can't deny the demand that's there from U.S. investors, both accredited and non-accredited. I mean, there's incredible demand. You know, obviously it changes through the cycle. Like it's, you know, the demand is not what it was in 2021, but it's still there. There's still millions of people that want to invest in it, hold it, trade it, et cetera.
Yep. Yeah, and look, every market cycle, there's a new story, right? There's a new wave, and I just hope that the next quote unquote alt season, whatever that looks like, I just hope it's not as rife with fraud and like these just meme coin things. I mean, there's just been so much on crypto Twitter, you know, just exposing like all of these meme coin rug pulls and NFT scams. I'm like, I'm over that. I'm like bored of that. Let's move on. Let's find something better. So
I think a lot of people have moved on from that, wouldn't you say?
Oh,
like,
yeah.
Like the majority of people kind of learned from their mistakes on all of that. And they're
maybe. I mean, I thought that in 2017 too, but you know, every market cycle, there's a new wave of dumb money that comes in and loses everything. So
it's true.
Yeah, I don't know. We'll see. I wanted to bring this up. Did you guys see the short? What basically Hindenburg came out and said that Icon's empire was a fraud. What the hell is this about?
Well, he has this very specific closed-in fund, trades under the ticker symbol IEP. And Hindenburg's right. I mean, IEP is a weird like house of cards in the sense that unlike most closed-in funds, it trades at just a incredibly massive premium to the underlying asset value.
Yeah.
Hindenburg also said that some of the assets were being improperly marked, et cetera. But either way, let's say the assets are marked properly, the premium that the IEP trades to its underlying asset value is like, it's like a 200%, or at least earlier this week before the short report dropped, it's like a 200% premium. It's the highest premium of any closed-in fund in the universe of closed-in funds or something.
Wow.
And so they're right that, like, you know, Icon, to his credit, sort of has been taking advantage of that by selling more IEP stock and using it for personal purposes, using it for further like acquisition of assets. So, I mean, it's kind of what I would do. Like if I had a closed-in fund that was trading at a massive premium to the underlying assets, I would be issuing stock like crazy.
Yeah.
And trying to arbitrage that premium. And so I don't know. You know, Icon, obviously, like he's made a lot of great investing decisions throughout his career. He's not like a fraud in terms of like being a good investor. He's aggressive. He's activist. He, you know, has been in some questionable situations for sure. But, you know, he's like, I don't think Hindenburg is going to sort of like erase Icon's track record. But for sure, the IEP vehicle itself, I think they've raised some really important questions, and the stock market seems to agree for whatever reason.
Yeah, I mean, it's always interesting whenever you see these reports hit. It's like being an activist short seller makes a lot of sense sometimes. I mean, you guys did this at the fund, right? Not like putting out reports, but trying to find like obvious frauds.
Yeah, absolutely. Yeah, and actually being a short seller is really, really difficult. It's way harder than being an investor on the long side because there's so many ways you can blow up being short stocks.
Yeah.
And we learned that lesson with Volkswagen short squeeze and other things too, where there was a company that I had found and done a ton of work on for weeks, and it was a small cap company, but it was still trading at, I think, like, you know, $800 million, $900 million. And the founder was just like repeatedly lying to investors with press releases and announcements of products, and that the company was going to soon be in explosive growth mode years and years and years. And this never happened. And yet the stock kept trading at like this insane valuation. And it was like the market never cared. And it was like you could be a short seller and uncover fraud, and sometimes the market doesn't do anything about it.
That happens in crypto too, man. Isn't that funny? I mean, there's like this perpetual like movement of money that causes markets to want to go up, right? It's like people want to invest in stuff. And yeah, if you're just long assets over a long period of time, you're going to build wealth. But it's always fun and interesting to see these like tactical, like rip your face off short moves.
Yeah. They're like Hindenburg's has a pretty good track record too. So yeah, when they put out a report, it moves the market. And they're more often than not right. They haven't always been right, but yeah, people are going to be pissed. Like people, when they put out a report on a company, they you don't want to be long in that company.
It's funny when I see a chart like that, the first thing I think of is like, ooh, man, a bounce play, like a reversal. How the trading on that could probably be pretty incredible. I don't know if it's going to bounce, but when I see those big washouts, I'm always thinking like, oh, a bounce trade.
Yeah. What else do we need to talk about on the macro side? I know we've got the debt ceiling fight that's really heating up. I mean,
it's also
I've always
dumb.
said that it's all bullshit anyway. Like, I mean, how's this going to play out? Is it going to affect anything?
It's all bullshit till it blows up the financial markets.
Yeah, that caveat.
Yeah. No, but you're totally right. Like in the past, it's mostly been just a big show. The market freaks out about it for a couple of days or a couple of weeks, and then they come to their senses hours before the deadline and fix it. But a lot of people, including myself, have said this time could be a little bit different in the sense that like because politics have become so hyper partisan in the last few years, there is definitely a higher chance than normal that they could actually go into a technical default for, a couple of hours or a couple of days, or at least be at a point where they have to cut parts of the budget or shut down the national parks or shut down parts of government while they keep paying debt holders until they can raise the debt ceiling. It is bullshit for a number of reasons because not only one, do they usually just extend it, but also it's bullshit because like Congress sets the budget in a completely different process. And this is the debt ceiling is really only about like, can we spend the money that we've already allocated?
Yeah.
And so the parties who are not in power will often use it as a means to try to renegotiate the whole budget thing. And it's just
such a disgusting show.
Disgusting.
Yeah.
I have a fun fact about Congress. Did you know that about 63% of Congress is boomers and older?
Makes sense. I thought it would actually be higher.
Really?
Yeah. I mean, I guess 2/3 is still pretty big.
I'm surprised Gen X hasn't come in more.
Yeah.
I mean, think about it. I was thinking about this a lot, and I'm like, should people that are working, trying to build their wealth, like in the thick of it, trying to buy homes, should they have more representation in Congress?
Yeah.
Like at what point is age just a number, or is the generation that's older, they have more experience? Is it really helping us versus Gen X, who's younger and like more in touch? If they had more power in Congress, what would that look like, and how different would that be?
Yeah, there's a spectrum of like experience and age, and then like future skin in the game, right?
Right.
Like,
yes.
I can't remember if we talked about this on the show, but I did a Twitter poll and I was like, hey, what do you guys think about like giving more weight to younger people's votes?
No,
oh man.
No.
And I knew that was going to get like a lot of people like really pissed, but I was like, think about it. Like you have people that have more skin in the game. The decisions impact them for a longer period of time.
Right.
So no, it's not smart, but I thought it anyway.
Well, I mean, I guess like talk about Gensler and not being able to answer questions, and you watch a congressional hearing on different technology forward topics, and it's like, okay, we need some more Gen Xers and millennials up in here to like help.
A lot of them are definitely out of touch.
So I just found that interesting. I thought that Gen X would have more control, but not. They're starting to, but it's not as much as I thought.
There's some of those senators, like I know there's one, I think, I hate to name names, but Dianne Feinstein, for one, is like, she's doesn't show up for votes anymore. Like they actually like are having issues now because like the Democrats actually are losing their slight majority in the Senate because she's not showing up for votes. Like she's just like gone. Like she won't. And so,
where are you?
And so like people are like, hey, if she has dementia or something, fine, but we need to replace her or do something. Like she can't just keep sitting there and like doing nothing. Like it's a very important role to have in U.S. government. You know?
My God. Hey, at least, what was it? AOC and the other dude, they came up with a bill trying to ban Congress people from trading stocks. Did you see that?
I did see that.
Who was the other guy? Matt Gaetz. Yeah. It was kind of like extremes on both sides came together and were like, yeah, this probably isn't legal.
Letting everyone insider trade in Congress. I mean,
that's essentially what they're doing. They have the most information of everybody.
Yeah. You would think that they would have figured that out a while ago, but I guess, they have no incentive to make it illegal.
They got to build their wealth too, guys.
Yeah. If only I could have the track record of Senator Warren
or Pelosi, right?
Pelosi,
the Pelosi tracker, or
God.
Tommy Tuberville. Yeah,
isn't Pelosi the best trader of all time? Her husband is.
Yeah, she is the number one trader in the entire world. Her skill level is way beyond what we can ever achieve. Oh man. Okay, guys. Well, let's do a recap here. So markets are gonna crap the bed tomorrow after Apple.
Maybe. Apple probably will have banging services, growth or something like that.
Yeah.
Save the market.
Services will save them.
Yeah, they're just gushing cash still, and I don't know. We'll see.
Yeah. Any other plans, thoughts, ideas? What are you guys working on? Looking forward to?
I am looking forward to being done with this earnings season.
Yeah.
I'm glad that things are shaping up better than expected. That was kind of something that I thought about and how I'm going to react to that. So the more data, the better, right? Now we've got the rate hike out of the way. I see the odds of no more rate hikes being pretty high, right, from here. Yep. So that's good for the stock market. So I'm kind of just right now, it's like, what is the price action going to do after this week? After that information is here. That's what I'm going to be really paying attention to. If the price action is strong and we end up ripping for a breakout on the S&P 500, are we buying that? I don't know. I don't know if I don't know if I'll be buying that, but I will be buying a pullback that happens if it happens.
Yeah. I think one thing I'll call out again is that the April CPI head fake, which comes next week. So the April CPI out, I believe, on Wednesday. That could spook the market. I don't know. I don't know how much people are paying attention, or if they're just going to look at the number and say, 5.2, it was higher than the March number. Oh shit, maybe the Fed needs to hike more. Maybe the bond market's wrong. But again, it's going to be a head fake because I think by 1 or 2 months later, we'll see those numbers. In fact, I think even the Cleveland Fed's forecast for the May numbers, which, they're not finalized, but the May numbers are already supposed to come back down in the low 4 range. So it's going to be like this weird, short uptick in April, and then
like a lower high kind of thing.
And then things will start to come back down again. So I don't know how the market's going to react to it. It's going to be interesting to watch if the market's going to look past it and say, it's just an April issue, or if a bunch of people are going to go, oh shit, maybe the Fed needs to keep hiking. Maybe banks are effed.
Doesn't the market see the estimates and see that that's kind of expected to happen?
You would think so, but at least among a lot of the investors and macro people on Twitter that I follow, it's like they seem to be missing very obvious things sometimes.
The other thing is didn't we have private payrolls today or the other day or today? I can't remember what.
Yeah, there was the ADP report, and then we had the JOLTS report the other day as well.
But most recent one, it was better than expected.
Yeah, ADP was, yeah. Oh, that's right. We get the official unemployment report on Friday for the month of April.
Oh, that's going to be interesting. So there's still a lot we need to see.
Yeah. So, I mean, I guess, kind of thinking about everything that we've talked about and looking at the charts, kind of makes sense that the markets have just really flatlined over the past month.
It kind of does, to be honest.
Kind of been stuck. There's been head fakes on both sides. There's been fake out breakout. There's been short traps, just really kind of building up that momentum and consolidating.
It is kind of amazing that we had the whole FRC, quote unquote failure or forced takeover, and the market didn't really go down very much. It was down the other day when the KRE regional bank index was down 7%, and it looked like, maybe there's more dead bodies about to float to the surface. But, with the FRC situation, it was strange. The market really wasn't reacting that negatively. So that could tell us something. I don't know. It's all very confusing.
I think everybody's pretty confused. Anybody that's going into this with any certainty, I don't know where they're getting the kahunas to feel so certain. I'd like some of that juice, whatever that is, because I mean, even some of the most distinguished professionals that I see that I respect are even like, this is a weird place to be, y'all.
Yeah.
Like, this is a strange environment, so
T-bills and chill.
T-bills are great, but
Bitcoin and build, or Bitcoin and ball. Bitcoin and ball out. There you go.
I guess technically, like that would be the appropriate situation right now.
So T-bills, property, what else? Maybe just enjoy life, have fun, travel, play pickleball.
Yeah, don't take it all too seriously.
Yeah.
Try to
diversify.
Yeah.
Diversify.
Well, there we go. All right, guys. Well, anything else you guys want to impart wisdom on our community or audience this week?
No, but please join us in the community if you're interested in being part of what we do, helping contribute to the research, seeing our trades.
Yep. Yeah, go to wetalkmoney.com/community. Also, make sure to subscribe to the new YouTube channel. Leave us a review on any podcast platform that you listen to the audio on. And yeah, we'll see you guys next week after Apple, unemployment, what else? CPI, Bitcoin 30K resistance.
All the
next week
things.
should be a pretty big show, hopefully for some changes in the market and the price actions.
By the way, I do want to stress, if you can please leave us a review on Apple or Spotify podcasts, that'd be super, super helpful. I know many of you love our show, and we'd love to hear from you.
Absolutely. All right, guys. Well, thanks for all of your research on the stock and macro side. And thanks to you guys for watching and listening, and we will see you next week. Take care.